Topics 1 to 5 covered preparer type information. So that was going through how we have an economic event within the business, how we do all the various journal entries, how we end up with financial statements, and we're talking about external financial statements. We're talking about financial statements that get put into reports which get released to external users. Now, that information is useful because that helps you, one, if you end up being a preparer, you need to know how to do that. 2, if you're going to be someone who analyzes companies, sort of like what we did just then, whether in a professional sense or for your own portfolio, for your own sort of investment purposes, then topic 6, which we've just kind of covered some of the material for then, looks at how we do some of that. Where we move from there into management accounting, and this is sort of the first major topic in relation to that, this is applicable to any sort of business. If you run your own business, if you, even some of it, potentially in cases when we get to budgeting about how you manage your own personal life, this stuff's important. So what we're going to have a look at today is just some of the lead-in work on that. And it very much is about learning about cost structure. Because if you can work out what your cost structure is, then things like pricing and making decisions on, whether you should advertise, what you should do, what you should, as I said, what you should price at, various other sort of business-related decisions become internal to the business, become really important. So the things we're going to be doing today, looking at the nature and behavior of fixed and variable costs. We're going to look at regression analysis and high-low method. Now the reason we do that, and again, we'll reiterate this as we get to that point, is there are going to be some costs which are mixed. They have a fixed component and they have a variable component. And we need to disentangle those. And they're not always clear from the outset what that actually is. Now, if you're not too sure about regression analysis, some of you may have heard that term and go, yep, I've done that. You've done a stats course before, you've done some sort of quant methods course. We're not going to get you to do it in an exam because to do it by hand is difficult, to say the least. But making sure we're comfortable as to why we're doing these sort of things. So I'll show you a method with Excel and I'll show you a method during the high-low method. There are videos there. I've got specific short videos on that. So it just looks at that particular component. We'll look at income taxes, but that's a very short section. We'll then look at how we use variable costing to make decisions. And that's just an entree. Next week, we start to really get into the meat of it. So the really key thing today, really key, is to be clear about what the difference between fixed costs and variable costs are and why it's important to know the difference. That's probably, yes, there's a bunch of other things and methods to get to those points and things you need to do with calculating the information, but at the heart of it, if what you need to take away from today is we have fixed cost and what that means, and we have variable cost and what that means, and why it's important that we separate those two things out. So what fixed costs and variable costs are? A fixed cost can change. So it always sort of confuses people. It's like, well, it's fixed, should it just be? A fixed cost can change over time. What fixed costs mean is over a period of production volume, over a period of an amount of output, that cost doesn't change. So if you have a plane that takes off from a commercial plane that takes off from somewhere and it has 0 people on board, and I've seen photos where, like, some of them been in Africa where someone's been on board and like literally they've been the only passenger on the plane. They've got like a 300-seat plane and they're the only person on it. You might have 1 passenger on the plane, or you might have 300 on the plane. There are certain costs associated with that plane which won't change. One of which is, I'm assuming, they're going to have the same number of pilots. Because it doesn't matter how many passengers you have, you still need pilots. At least for this point in time, on a complete side note, would you guys be comfortable? Because we're getting to the point with AI where pilot literally has to do about 2 minutes of work on the plane. Would you be comfortable? And we know there are drones. We know you can operate these things remotely. How comfortable would you be This is an accounting question. How comfortable would you be getting on a plane where the pilot is in an office and not on the plane, is just remotely piloting it? Would you fly on that plane? I don't know. I don't know if I would, to be honest. I like to know that whoever's in the cockpit has some skin in the game, because they're going to want to make sure that plane gets to where it's going. There's slightly less incentive if they're not actually there with me. So anyway, it's completely different topic to what we're talking about here. So fixed costs are where that cost gets incurred and it's fixed regardless of how many units that you sell or passengers or customers or whatever it happens to be. A variable cost is one where it does vary with the amount of people in there. So the example I wanted to use, just because it's close, so the tram line just runs out that, well, it doesn't run out the window. Tram line's just down the window there. This is George Street. That's the Capitol Theatre. I don't know if you've ever been there, I haven't. But the Capitol Theatre fits about 2,000 people. So I went and did some research on this before this class. So it fits about 2,000 people, maximum capacity. It costs, at least the latest data I could get, because often with these things you actually have to call them to get information on quotes and stuff. But somebody had actually done a big research report on the cost of various theatres around the place. So at least in 2015, to hire it was about $11,500 plus staff. Now, let's ignore the staff for the second because we don't know what those costs are. Let's just look at the theatre, that $11,500. So let's just assume that's a full fixed cost. We pay that and we get staff and we get the place lit up and the electricity running and all the rest of it. What is the minimum? Let's assume that's the only cost there is. What is the minimum we would have to charge? We're going to hold a show about accounting down there. Now, maybe we'd have to pay people to turn up for it. Maybe we couldn't get them to pay us. What is the minimum we'd have to pay people to make a profit on it if that's the only cost incurred? Yeah, so $5.75. At $5.75, we will cover our fixed cost. That's assuming there's no other costs there. So $5.75, we'll make $11,500 if, and that's a big if 2,000 people turn up. It's an accounting show, so we might not get that many. We might get like 200, and then we're in trouble. But if we were to charge $4, we're going to lose money. Like, there's no question that we're going to make money on this thing. $4 at most, we can make $8,000. At most. We could make less than that, but at most we're going to make $8,000. This is why breaking out your fixed and variable costs is important. That cost, if we get one person to that show, we would need to charge them at least $11,500 to cover our fixed costs. And I'm pretty sure no one is going to be paying that. So this is when you have to start to run sensitivities. Like, well, what happens if X number of people turn up? Like, where would things be at? How many people do we think can turn up? Do we need to just cancel it? I think it was, you see entertainers and you see people cancel shows time and time again because ticket sales aren't up to expectation. I'm pretty sure one of the last people when I say I saw it in the paper, I didn't see them, but I'm pretty sure Pitbull cancelled his Australian tour because ticket sales weren't at the level where it was worthwhile coming out. Now, to my mind, that actually is quite okay with me. I've got no problem with that. But he just didn't get the market. So we want to know fixed cost. So fixed cost as a function, we're going to start to build in a little bit of algebra here. As a function, y is total cost, y equals a. A is your fixed cost component. That amount there doesn't vary, is not impacted by quantity at all. That's why it's a fixed line, as what you see there. Fixed line with no slope. Amount of volume doesn't change, but per unit, the more units you sell, the more you spread that cost out amongst lots of units. The cheaper that then becomes per unit. Variable costs vary, but they vary, that's why they're called variable costs. but they vary by output. So if we're putting on a show and we need to entice people to come to an accounting show, they need a drink. They may need more than one drink if it's an accounting show, but they need a drink. We're giving them a drink as part of the ticket. That means there's, say, a $2 cost for the drink that gets attached to the ticket. So every ticket that we sell, there's a $2 variable cost. No, we sell no tickets. We don't have to worry about buying any drinks and giving away any free drinks. So the variable cost, the total variable cost is zero. If we sell 2,000 tickets, we need 2,000 drink. That's cost us $4,000. And you can see how that works up. And it works up in a linear fashion. So in this case, the cost y equals b times x. B is the variable cost per unit. X is the quantity. So it is a function based on quantity. So they vary directly, but per unit, it's an equal amount per unit. Mixed cost, a little bit of both. And there are lots of things where you can consider mixed cost. Utilities cost, in a lot of cases, are mixed. So if you pay your electricity bill, if you pay your, if you pay your water bill, there's an infrastructure charge. So if we're not at home for 3 months and we use no water at all, we will still have a water bill because we pay Sydney Water for a certain amount of electricity, certain amount of water infrastructure. Then usage gets added on top of that. So there's a fixed proportion and a variable cost proportion. What's critical about this, and we'll get to it in a few slides, so the mixed cost, that total mixed cost y equals the fixed component A plus the variable cost per unit times the quantity. What's important about this is we may have this fixed cost and we know we're paying Sydney Water a certain amount each month or each quarter, but we may not necessarily have visibility about what is the fixed component and what is the variable component. It just may be a number that we get given. So, and it may not even come all the way down here. We may have sort of a graph which looks, we may have information which looks something like that. We can't tell what the fixed bit is. We can tell there's a slope. We can tell there's a variable component. So, and this is quantity, quantity, and that's cost. So we can tell there's a variable component, and we can kind of see it's going to have a fixed component, but we don't know exactly how much. In a couple of slides, we're going to see how we do that. But it's important that we separate those two things out. So what we end up with is total cost behavior. This becomes a really important thing. This is critical for the next 3 weeks or so. So total cost, we're changing it from expenses to cost. We're thinking in costs now. This idea that total cost equals total fixed cost. So I'm just sort of writing it out. So the total cost for whatever the thing we're dealing with is separated out into the total fixed cost plus the variable cost per unit times quantity. So we have 3 pieces of information now that we need to know. We've got whatever the fixed cost component is, which we may need to estimate, which we're about to do. We've got the variable cost per unit, so that might be, so if we're thinking about the Capitol Theatre, we'll get back to this in a second, and this is the quantity. So we've got total fixed cost. We may have, for the theatre, $11,500. That's how much it costs us to hire the place. We have fixed cost per unit, which is $2 for the drink. And then we've got quantity. So if we sell no tickets, our cost is $11,500. If we sell 2,000 tickets, our cost will be $15,500. We're now in a position where we can kind of work some stuff out and then potentially work pricing off the back of that if we want to make a profit. That we'll expand on next week. So that little bit there is really important. So there's total cost behavior. Before we do the regression, before we try to figure out and tease apart the mixed cost, there's one thing that we need to cover off, which is really important. So the relevant range is a normal range of production capacity that can be expected for a particular product or company. Now, this is the one where the relationship that we're looking at is linear between cost and output. Now, what I mean by that is the following. Let's just get rid of this for a second and redo it. You guys can all see this up the back? You guys can see this? No? It's the only color I've got to make. All right, hopefully that's a little bit more visible. So imagine we want to hold a show, county show. We think we may get, 1,000-ish, 1,500, 2,000 people. So that's kind of, let's say 1,000 people, that's 0, that's 2,000 people. So that cost has a linear like that. So between about 1,000 and 2,000 people, it makes sense to have it at the Capitol Theatre. It's not too big. Yes, it might not be full, but it's about right. If we're expecting less than 1,000 people, we probably shouldn't have it at that venue. It's probably going to be too big for what we need. So we find a venue that has a capacity of 1,000 people. And that may cost us, maybe some of the Enmore. No, Enmore's too big. Metro, or part of the Metro Theatre. So for 0 to 1,000 might be, we could find a smaller theatre which would fit for that range of people, that expected capacity, and that only costs us $5,000 fixed. So the relevant range, if we're thinking from a potential sales of up to 1,000 people, the fixed cost would be about 5,000. But if we need more than 1,000 people, we expect more than 1,000 people to show up, we're going to have to move to a bigger venue. And then we choose that venue, and that's going to have a higher fixed cost. If we think this accounting show is going gangbusters and lots of people are going to come along to it, and we can always dream, maybe we need to go to somewhere like, the Enmore or somewhere bigger. And maybe that costs us 25,000. Maybe if it's going to be really popular, we need to go to like the ICC just down the road here, and maybe we can fit in more people. I don't know, but you can see the point I'm trying to make, is that the range is just where this is linear. We can't use 5,000 over this range because 5,000 is not going to work for us if we have 2,000 people turn up. That's all we're trying to get at. Same thing for variable costs. So you may see a function which goes like that over a particular range. So it's like $2 a drink for this many drinks, but then may start to flatten out a little bit because you may be able to get quantity discounts because you're buying more, and may start to flatten out even further and keep going like that way. So again, it's not linear over a larger range. So the relevant range is just where the function is linear. So what we're going to do now, and you've got the data. So we're going to play with some data that's in the sheet here. I've already set it up in Excel that I'll just literally typed it all in just while we had a break. Just a quick show of hands. Quick show of hands, just so I get a sense of where to pitch this. How many people have heard of, and before today, obviously now I've spoken about it, you have. Before today, how many people have heard of regression analysis? Like right up. All right, so kind of about a third to a half of the room. You've heard of it, have you done much with it? Have you sort of, all right, so sort of. All right, this won't take all that long. So what I'm going to show you is how to use Microsoft Excel and really hack a method to give you a regression analysis. But before we do that, just to explain what we're actually doing. So imagine we've got a series of data points that kind of looks like that. So we'll have output, we've got cost, and this could be for a series of periods of time, weeks, months, quarters, whatever it happens to be. You can clearly see, although given it's a color red, it might be a little bit hard up the back, you can see that there's a relationship there. You can see that as output increases, the cost increases. It's not perfect, but it's there. The whole point of a regression analysis is to find the line of best fit through that. What's the line that best represents that relationship? Now, the way it does it is to calculate the distance between it. It plots a line, calculates the distance between the points, and then plots another line and calculates the distance between the points in that line. If that line's got a smaller total distance between it, that's a better fit. And then it just keeps iterating until it gets to the best fit. So if I was to have a line like that, those would be all the distances from the various points down to that line. Now those, you can see if we do them all, are going to be quite big. So that's going to look like a pretty rubbish line. If we draw it through like that, I'll just come up here. You can see how these distances are much better than those distances. Now, there's a lot of theoretical stuff about, the types of data points and where you can't use this stuff, but that's the essential idea. So we've got a line of best fit. Now the idea being, as we plot that through, it'll intercept, and that bit there is the fixed component. So we can estimate what the fixed component is, and that slope is the variable cost per unit. That's what we're doing. We've actually then just created that line. We're going to come out with an equation which will show us what the variable cost per unit is and what the fixed cost is. So we've got this following data here. If you've got it in front of you, there it is. As I said, this next little bit, I've got videos on it. So if you want to sort of watch it through again, you can see how it works. So what we have is, this is data set up in Excel. It's the same, exactly the same information. To do this, without using any sort of fancy statistical software or data packages, all I do is I select it, I insert a scatter plot, and what I've done is to basically create what we've got up on the board. But we don't have the graph yet. As a side point, just something being mindful of when you're looking at graphs, this is kind of badly laid out in the sense that the data points are all up here, and there's all this big open space down here, and there's all this big open space over here. So that's not a really well set out graph. So we'd want to shift it around a bit just to make it more centered. But the thing I wanted to sort of point out is, this looks quite flat. Like, there's a bit of a, you can see there's a slope, but it looks reasonably flat. It looks like there's not much of a relationship in terms of variable. What I'm going to do is I'm going to change your perception of that without changing the data. So format axis. Suddenly, that is exactly the same data. There's nothing that has been changed with the data that's been put in. That suddenly looks way worse. If you think a bigger increase is worse. That suddenly looks like the relationship is much higher variable cost. But I haven't changed anything. All I've done is change the axis. So when you're seeing graphs and tables in the media, when you're seeing graphs and tables in company output, think about, have they sort of set it up to make it look different? Have they changed the scaling of things? Have they dropped stuff out to sort of make it look in a way that they potentially want you to think about? But I actually want to keep it at the origin, so I'm going to bring this back. So the way you do it is you right click on one of the data points, add trend line. We wanted to keep it as a linear trend line because a linear trend line is exactly what we're doing. We want to display the equation on the chart, and I'll display the R squared, close it down, and that's it. So what we've done is we've created a line of best fit through the data points. What the R squared tells us is how good a fit it is. An R squared of 1 is a perfect fit. An R squared of 0 is, it's got nothing to do with anything. An R squared of 0.89 is awesome. Like you can basically say, we know what's going to happen based on this. This is A. That 3998.3, that is your fixed cost. It's an estimate, so it's not bang on perfect, but it is as good as we can get as an estimate. So 3,998 is the fixed cost component of the utilities for this pizza shop. And then the variable cost, this is the B and this is the X, is 2.0919. So what this tells you is for every pizza you make, there is $2.09 in cost being incurred. You sell no pizzas, there's none of this cost happens, but you still have this. You sell 1,000 pizzas, there'll be $2,091 of variable costs, total variable costs, and there'll be $3,998 of fixed costs. That's without using any fancy software to do it. We've got the equation we need. But in an exam, you're not going to have Excel with you. So we need another method to do this. And the method we have to do this is what's called the high-low method. And now that we've done this, and you can kind of imagine if this line tracked out, kind of keeping going, it sort of hits about there, which is what it does. What the high-low method does is that's complicated to calculate out, but what's not complicated to calculate out is the difference between this point right here, the lowest quantity point, the lowest output point, and this point up here, which is the highest quantity point. So it's like we're putting an imaginary line between those points. So the way to do this is eyeball the data and find the highest quantity. Highest quantity is 2,600 units. You then take the cost associated with that quantity. You don't then just look independently at the cost and find the highest cost. So it happens it is the highest cost, but you don't go elsewhere for it. So find this one, you use that. We then go down 1450 to 1200. 1200 is it. So now we have the lowest quantity over that period of time and the cost related to the lowest quantity. And all that we're doing is taking the marginal difference between those two amounts. So the difference in terms of quantity between the highest quantity and the lowest quantity is 1,400 units. This is good because what we then do is figure out what the marginal cost is between the lowest quantity units and the highest quantity, and it's 3,350. And we just want it for one marginal unit. What we've now calculated is a variable cost. That's the variable cost per unit. So we're just going from here to here, from here to here. That's 1,400 units. That's 3,350 in extra cost. So for each unit, it's 239. It's a different number. The function is different. You could see it graphically if we were to draw a line between those 2 points. But it is kind of close. And it's workable for what we need. So that gives us, if I get rid of all this for a second. That's awesome. So that gives us 239 for variable quantity. But what we want is this, and we don't have it yet. So the way we do it is just feeding the other information we know, either using the low or the high quantity. I'm going to use the low quantity because we're already down there. So for the low total cost, column C is 6,750 equals total fixed cost plus variable cost, which is 239 times the number of units. We know the number of units is 1,200 units. So this plus total fixed cost, this equals total fixed cost plus 239 times 1,200 units. And then we just need to solve it out for that because the only thing unknown is total fixed cost. So we just multiply things out, move things around, and we'll end up with total fixed cost equals 6,750 minus 239 times 1200 equals 6,750 minus sorry, no, just 28. Yeah, it is 28 something, isn't it? 287. I'll just round it off 2871. You're going to get some rounding error here. Like you could do it at 239. You could do it at 239 with all the decimal places. Look, as long as you round it off to the cents for variable costs, like sort of to 2 decimal places, I'd round these off to dollars. Like honestly, it's not going to cause you a problem in an exam. Like we will be aware that there will be rounding, so it's no stress. So 6,750 minus 2,878, just to do that here, is 3,879. 3,8. Look, and that's, I think, probably a little bit different than what's in the slides. It may be different if you were to do it with different rounding. It's different to what we worked out with the regression, but not hugely. It's like $100 or so out. It's about 30 cents out. You know, it's in the ballpark. And it is a looser approximation. So that's why we did what we did. It is to get that, because we need to know that. And it's to get the variable cost per unit. Once you've got those two figures, you can do lots of interesting things with it. Like hold accounting shows down at the Capitol. I can imagine a big turn up for that. So yep, that's other output that we don't need. Done that, done that. 3882. Yeah, so look, we did it slightly different and we're $3 out. That's not material for what we want. You guys can do that at home because time is something we just need to be aware of. So the impact of income taxes on cost and decision making. This is an ongoing discussion in pretty much every economy around the world. Like how big should government be and how much should they be taking out of everyone's pockets? Depends on your position on things. Different people have different views on all of this. But at the heart of it, apart from some jurisdictions, the government will take some of the profits that you make as income tax. In most places. Some, they don't take any, but. So most costs are deductible and most business revenues are taxable, which is arguably why a lot of, especially smaller businesses, operate on a cash basis. So there's no real trace of what happens. Maybe they're doing it because it's easier for them. Maybe they're doing it for tax avoidance reasons. I guess we'll find out. So the actual cost of something needs to be taken into account after tax. So if you have a $20,000 spend, which is tax deductible, if your tax rate's 30%, which in Australia on corporate tax rate it isn't anymore, so we're going to have to adjust these slides to pick that up. The cash flow effect will only be in the overall, will only be $14,000. They'll pay the $20,000 and then they will effectively get a saving of $6,000 because their tax that they have to pay to the ATO will be reduced by $6,000. So it's not that they get cash. The ATO, unless they've taken too much from you and then they give you money back, the ATO won't just give you money back. If you've made a loss, they will just give you a tax credit and then you get money back when you start making profits. If you make a loss, they don't go, here, have some money. It would be good, but it's not what they do. So 14,000 is the 20% times 1 minus the tax rate. So the last thing, and I'm not going to go into a huge amount of the detail towards the back end of this particular area. I just want to sort of guide you into why we show both. So we show absorption costing and we show variable costing, but why variable costing is the one that we want to use from here on in. The reason we show absorption costing is not just to have a couple of slides so we can talk about it and kill some time. The reason we have absorption costing is because that is what we've been used to and we've been doing so far. So absorption costing is how external financial reporting works. So remember when we buy any sort of inventory or property, plant, and equipment or any asset, the cost of that asset is every cost included to get that asset to where it needs to be. So when I buy my shoes from the UK, the cost of the shoes, the cost of the shipping, the cost of the foreign exchange difference, all of and the bank fees and all the rest of it, that gets all included into the cost of the shoe. That's absorption costing. With variable costing, the only things which you talk about are the variable, in terms of, from a production point of view, are the variable costs. Anything which is fixed and may get allocated out, you don't include in the variable cost component. We sort of separate things out. So the reason we've shown you a little bit of absorption costing, the reason why we talk about variable is it's a much better way to do things. And it is what we're going to focus on over the next 3 weeks or so. So where is it? That's not good. Manufacturing costs. Where's my phone? I don't know. I've got an Apple phone, just because now I've never started off as an Apple person, but now I've got an Apple phone and I've got a few other bits and pieces. It feels like it's too hard to shift out of their ecosystem to do something else. So now they've kind of trapped me. I think it sounds like the Samsung phones are actually pretty good, but like got iTunes, got iMusic, got all the sort of various things, and it's like, well, it's just too much fiddling around to move from that environment and ecosystem to something else. So they've kind of got me now. And look, it's a phone, it makes calls, I can search on the internet. I'm not too worried about all the other bits and pieces as to why it's good or why it's bad. Direct materials. If Apple were to make 1 million phones, how many screens would they need? I'd say at least 1 million. They can't get away with 500,000. Like you'd need at least a screen per phone. You don't have 2 screens per phone. The only reason why it'd be slightly more than 1 million is there'd be breakage, there'd be defective ones, other things happen in the manufacturing process. So direct materials, these are variable cost. You make no phones, you don't need any screens. You make 1 million phones, you need 1 million screens. So there's a variable component to that. Direct labor. I don't know how long it takes to make a phone. And I know there are people involved physically in the process, but I don't know how long. Let's say an hour. If I make no phones, I don't need any labor. If I make 1 million phones, I need 1 million hours of labor. It's variable. Manufacturing overhead is slightly different. Manufacturing overhead, some will be fixed, some will be variable. If we rent the factory where we make these, if we make nothing, we're still paying rent. If we make lots of them and we're using the factory 24 hours a day, we still pay the same amount of rent. So that's a fixed component. But the electricity used to run the machines will have a variable component to it, because the more you run the machines, the more electricity gets used, the higher that cost is. So there will be elements of overhead which don't specifically relate to a phone. It's not like the electricity relates. You can say that little bit of electricity went into this phone. It's just electricity got used. But some of it's fixed, some of it's variable. The thing to look at with this is, on the left-hand side, we've got absorption costing, and we've got variable costing on the right-hand side. We've got product costs, which attach into the product, and we've got period costs, which is sort of get expensed out. If we look at absorption costing, the product costs, direct materials, direct labor, and all the overhead. So every one of the things which directly relate to making that product get included within the cost of that product. That's what you see in just a financial report. But when we're worried about sort of variable costing, we're just worried about the things which are variable get attaching in. So direct materials, direct labor, and the variable overhead. The thing which differs between the two is the fixed overhead. Ends up in product cost and absorption, ends up in period costs over in variable costing. So this is an example we're finished with. We're not going to go through the variance, not in this class, because there's enough we've had to get our head wrapped around already. I would like you to have a look at that between now and next week. So the sections where you make a different amount to what you sell a different amount to what you produce. At this point in time, I just want to break down what we see here and then the next slide, and that'll wrap us up. So they produce 100,000 units per year. What we have is 30 cents in direct materials, 35 cents per unit in labor, variable overheads of 10, variable selling admin of 5, and then fixed manufacturing 30 and fixed selling 10. So if we think about the variable costs, we've got direct material, direct labor, variable overhead, and variable selling and admin of 30, 35, 10, 5. Those are the product costs. Those are the variable product costs. Direct materials, direct labor, variable overhead. What's that? Product. Sorry, I can't hear.
Multiply the 100,000.
The.
Multiply the 100,000 totals.
Yeah, no, we do have to do. Oh, so we haven't actually. We're just working out the per unit. We do have to do that, absolutely. But at the moment we've just worked out we're working out the per unit, and then we do that. For the fixed costs, we have 30,000 fixed overhead and 10,000 variable overhead, and that's the product cost. So we've got 4 variable costs, 2 fixed costs, and then 4 product costs and 2 selling and admin costs, sort of split between them. So we work it all out with the product cost for absorption costing. Actually, if you look at the product cost for both of them, the first 3 lines are the same. We include all the variable product costs in there. So of these, those get included, their product costs, their variable costs, they get included in both. What differs is that absorption costing also includes that. And the way it gets included is to go, well, we included, let's say that was factory rent. We've got $30,000 in factory rent. We made 100,000 per year. We made 100,000 units in this year. We're going to just separate out that $30,000 and give a little bit to each unit that we make. So we made 100,000 units. That's 30,000 divided by 100,000. That gives you your 30 cents. So what we're doing is each unit that you make is absorbing a little portion of that overhead. That's why it's absorption costing. And this is the last slide we'll do today, and I just want to talk through the components of it because it's useful to do that. I'm actually going to do this written down because there's a bit we've got to show here. And it's going to look neater, I hope. All right, so on the left-hand side, we've got absorption costing. On the right-hand side, we've got variable costing. So we'll do absorption costing first. So sales equals price times quantity. So it's the price per unit, and this is the selling price per unit, not the cost. So when we're talking about price, we're talking about what you sell it to someone. When we're talking about cost, we talk about what it costs you. So price times quantity, that equals 2 by 100,000 equals 200,000. Less cost of goods sold, that is product cost per unit times quantity, that equals the $1.05 times 100,000. That equals 105,000. That gives you your gross profit. And that's just the difference, so it's 95,000. less sales and admin costs, and sales and admin costs are the variable sales and admin costs per unit times quantity plus fixed sales and admin. So that equals the 5 cents times 100,000 plus 10,000. That equals 15,000 equals profit of 80,000. So I've just unpacked, and we'll be doing a lot of this sort of stuff, and it's really, really powerful to be able to do it, but we've unpacked how we get those figures on the left there. So sales is made up of price and quantity. Cost of goods sold is product cost per unit and quantity. Sales and admin, because gross profit and net profit are just subtotals, so they're just based on what other information you've done. And sales and admin are variable sales and admin costs per unit times quantity and fixed sales and admin costs. So I didn't bring a highlighter, that's all right. So if we look at these, the key thing I want to sort of point out, this is how it gets done in external financial reporting. It's not that handy for internal decision making for the following reason. Where does quantity show up? Quantity shows up here. Quantity shows up here. Quantity shows up here as well. Quantity actually also shows up in there because part of the product cost per unit is the fixed overhead allocated out. So that requires quantity. So like quantity rolls into this in multiple different places. And that means if you're trying to run a variant, yes, you could set it up, but if you vary quantity, sales is going to change, cost of goods is going to change, gross profit is going to change, sales and admin expenses is going to change, your bottom line profits change. Every single thing shifts. And if you're trying to understand what's driving what you're doing, that's hard to do. That's hard to sort of take something away from it. So we compare that, and I'll blow it back up to full size in a moment. Sales equals price times quantity equals 2 times 100,000 equals 200,000. Less variable costs equals variable costs per unit times quantity. Now variable costs per unit here equal 80 cents. It's the 75 cents of product variable costs and the 5 cents of sales and admin variable costs. So we don't care what type of variable cost. It's just a variable cost is 80 cents. That gives you $120, and that's your contribution margin. Less your fixed costs, and your fixed costs are your fixed selling and admin plus your fixed overhead equals 10,000 plus 40,000. I'm running out of room. Sorry, 10,000 plus 30,000 equals 40,000. All right. And you can't see that. All right. Got a bit wibbly, but so what we can see here, sales minus variable cost minus equals contribution margin, less fixed cost gives you profit. You still end up with $80,000 if the amount you produce and sell is the same. But what's critical here and what changes is that when we look at this, where quantity shows up, quantity is here, and that's it. If we change quantity, if we change expected quantity, because remember, this is trying to figure out what's going to happen in the future. That fixed cost doesn't change. So that's what's powerful about this. If you're going to make any profit with this company, and the break-even point is where you make zero profit. How much does your contribution margin need to be? And we only just introduced it, so we haven't looked at it for long. What would your contribution margin need to be to break even in this case? Judith. It needs to be $40,000. So your contribution margin needs to be at least your fixed cost. So if you make $40,000 in contribution margin, anything above that, you're making money. You don't make $40,000 in contribution margin, you're losing money. Now, how much, I'll be interested to see if someone picks up on this. How much does each unit that we sell contribute to paying off our fixed cost? 1.2. Yeah, Carla's got it right. It's $1.20. Every unit that we sell contributes $1.20 to paying off our fixed cost. We sell it for $2, there's 80 cents of variable cost. So the difference between these two is the contribution margin per unit. So it's $1.20. Every unit we sell chips away at that fixed cost by $1.20. We sell 10 units, that's $12. We sell 100 units, that's $120. You keep doing that and you'll be able to work out what your break-even number of units is. And that's a really important number. Because let's go back to the Capitol Theatre, right? 11,500. We work out our cost structure, we make something up, and we work out that the break-even point in terms of people we need to go and see that show, the break-even point is 3,000 people. What's the problem? The venue only holds 2,000 people. So once we worked out our cost structure and our pricing structure, we worked that out and we need to break even. We need to sell 3,000 tickets, and we're not going to break the law on fire hazards by overselling. If we need to sell 3,000 tickets and we can only fit 2,000 people in, we're losing money. Like, there's no way that that works for us. So we either cut costs or we put ticket prices up. If you put ticket prices up, then you're starting to get into the economics of, will people start to walk away from coming up to the show? And then that's a slightly different question, but you can start to see why this stuff becomes really handy. So we will start to look at that in more detail next week. But the main thing is, variable costing is a really important thing to look at because it allows you to really focus on how quantity changes and keeps it isolated in only a couple of places. So we can work things out a lot more easily. That's it.